Gold just crashed harder than it has in nearly 2 decades. Then it bounced like nothing happened. And if you think that sequence was random, if you think that was just markets being markets, you haven't been paying attention to how this game actually works. Because what happened over the past week wasn't a normal correction. It wasn't healthy profit taking. It wasn't the market finding fair value. What happened was a coordinated pressure event that flushed out an entire generation of leveraged positions, transferred billions in wealth from weak hands to strong hands, and reset the board for the next phase of this cycle. And now that gold is back above $4,800 and silver is trading north of 83, everyone wants to pretend like the crisis is over. Like it was just a bad dream. Like we can all go back to watching the rally continue. But if you were one of the people who got stopped out, if you were one of the people who watched your account implode in a matter of hours, you're not feeling relief right now. You're feeling something closer to betrayal, and you deserve to understand exactly what happened, why it happened, and what it means for what comes next. So let's break this down, not with hype, not with doom, with the mechanics that actually explain this move. I'm Mr. AG, and this is the analysis that the mainstream financial media won't give you because it would require them to admit that the system they cover every day has structural features that consistently benefit certain players at the expense of others. Let's start with the facts before we get to the interpretation. Last Thursday, gold hit a record high above $5,580 per ounce. Silver reached an all-time peak of $121.64. The precious metals complex was on fire. Momentum was building. Call options were being exercised in a feedback loop that pushed prices even higher. The narrative was locked in. Inflation wasn't going away. Central banks were going to cut rates. The dollar was going to weaken. Gold and silver were the place to be. And then, in the span of less than 48 hours, everything reversed. Gold dropped 9% on Friday alone. That's the steepest single-day decline in years. By Monday, it had fallen another 3.3%, bottoming out around $4,545. That's a move of over $1,000 per ounce from peak to trough. In 4 trading sessions, silver was even more violent. From that high of 121, it collapsed to around $72 by Monday. That's a 41% drawdown, nearly half the value. Gone. If you were leveraged, you didn't just take a loss, you got annihilated. And then, almost as quickly as the crash happened, the recovery began. By Tuesday morning in Asia, gold was up 3% to 4,820. Silver was up 5% to 83.34. The bounce from Monday's lows was approaching 10% for gold, and even more for silver. So what actually happened? And more importantly, what does this pattern tell us about how these markets really function? The official explanation centers on one name, Kevin Warsh. On Friday, President Trump nominated Warsh to be the next Federal Reserve Chair. Warsh is a former Fed governor with crisis-era experience. He served during the 2008 financial collapse. He's seen as pragmatic, independent, and notably more hawkish on inflation than some of the other candidates who were in the running. Markets interpreted this nomination as a signal that the Fed under Warsh would be less likely to cut rates aggressively, less likely to tolerate a weaker dollar, and more focused on fighting inflation even if it means keeping monetary policy tighter for longer. That interpretation sent the dollar higher. And when the dollar rises, gold typically falls because gold is priced in dollars and becomes more expensive for foreign buyers. That's the clean explanation. The one you'll hear on financial television, the one that fits in a headline. But here's what that explanation doesn't account for. It doesn't explain the violence of the move. It doesn't explain why liquidity evaporated during the selling. It doesn't explain why the crash extended so far beyond anything that could be justified by a Fed chair nomination. And it doesn't explain the margin hikes that hit at exactly the wrong moment. Because the Warsh announcement was the spark, but the structure of the market was the powder keg. Let me explain what I mean. In the days leading up to the crash, the gold and silver trade had become extremely crowded. Speculators had piled in. Call options were at record levels. The feedback loop I mentioned earlier, where option sellers have to buy the underlying metal to hedge their exposure, had pushed prices into vertical territory. When a trade gets this crowded, it becomes fragile. Not because the underlying thesis is wrong, but because everyone is positioned the same way. And when everyone is positioned the same way, any catalyst that forces even a few players to sell can trigger a cascade. Enter the margin hikes. Over the weekend, the Chicago Mercantile Exchange announced it was raising margin requirements for gold and silver futures traded on COMEX. Margin is the collateral you have to post to maintain a leveraged position. When the exchange raises margin requirements, it's like changing the rules of the game while you're still playing. Traders who were fully positioned suddenly found themselves needing to post more cash immediately. And if they couldn't post that cash, they had one option: sell. Now imagine thousands of traders in the same situation, all needing to sell at the same time, all hitting the same bids, all trying to exit through a door that keeps getting smaller. That's a cascade. That's a liquidation event. That's not price discovery. That's forced selling, creating a vacuum that sucks price down far below where fundamentals would put it. And the people who understand this dynamic, the people who are closest to the plumbing, they don't panic during these events. They position for them. They wait for the flush, and then they buy the bottom that their own system helped create. I want you to hear something that a market analyst said during this crash. Tony Sycamore from IG told Reuters that the scale of the unwind was something he hadn't witnessed since the dark days of the 2008 global financial crisis. Think about that. An analyst who watches these markets every day, who has seen every correction and every pullback for years, said this reminded him of 2008, the worst financial crisis most of us have lived through. And yet, within days, gold is bouncing 10% off the lows. Silver is recovering double digits. The crisis is apparently over. Does that sequence make sense to you as an organic market event? Or does it make more sense as a designed flush, followed by a rapid repositioning by the people who knew what was coming? I'm not going to tell you. I have proof of coordination. I don't have emails. I don't have recordings. What I have is a pattern. And the pattern is this. Price runs up on momentum and leverage. Trade gets crowded. Then rules change. Margin requirements rise. Liquidity disappears. Price crashes far beyond what fundamentals justify. Weak hands get wiped out. Strong hands accumulate. Then price recovers and the cycle begins again. This pattern has played out in precious metals over and over in the late 70s, in 2011, in 2020. And now again, different headlines, different catalysts, same structure, same outcome. And the people who keep getting hurt are the ones who don't understand the structure, who think the market is a fair fight, who leverage up at the top because the momentum feels unstoppable, and then who capitulate at the bottom because the pain becomes unbearable. If you were one of those people this week, I'm not here to judge you. Plenty of smart traders get caught in these cascades. The violence of the move was genuinely unprecedented for many market participants. But I'm here to tell you that understanding what happened is the first step to not letting it happen again. Now let me talk about what the recovery tells us, because the bounce is almost as important as the crash. Gold recovering 3% in Asia, silver recovering 5%, Japanese stocks jumping 4%, Korean stocks up 5%. The assets that got smashed are snapping back hard. Why? Because once the forced selling is done, the fundamentals reassert themselves, and the fundamentals haven't changed. Inflation is still above target in most major economies. Central banks are still in a difficult position, torn between fighting inflation and avoiding recession. Geopolitical tensions are still elevated. The Russia-Ukraine conflict continues. Iran's role in regional instability continues. Trade tensions between the US and China continue. None of that went away because Kevin Warsh got nominated. None of that disappeared because margin requirements went up. The crash was about positioning and leverage. The recovery is about the underlying reality that drove gold and silver to record highs in the first place. And here's something else to consider. Deutsche Bank put out a report this week saying that investor motivations for buying gold are broader than in previous price surges and, quote, not likely to be allayed, unquote. That's a major bank saying this isn't just speculation. This is structural demand that isn't going away. They pointed to continued buying from central banks, China, Poland, South Korea. These institutions are not day trading gold. They're not chasing momentum. They're diversifying reserves and protecting against currency and geopolitical risks. That demand is sticky. It doesn't disappear because of a two-day crash. They also pointed to resilient buying from individual investors, particularly in Asia, who treat gold as a hedge against currency depreciation and a portable store of wealth. This is the part the mainstream coverage misses. The crash scared out the leveraged speculators, but the core demand from central banks and long-term holders didn't flinch. And that's why the bounce happened so fast. Let me add another layer here, because the global context matters. Australia's central bank just raised rates by 25 basis points to 3.85%. That makes Australia one of only 2 developed economies, along with Japan, to tighten policy right now. The reason they gave was above target inflation and a tight labor market. What does that tell you? It tells you that inflation is not dead. It tells you that central banks in some of the most stable economies in the world are still fighting it. And it tells you that the narrative of imminent rate cuts everywhere. The narrative that partly fueled the gold rally is more complicated than the headlines suggest. But here's the interesting part. Even with that rate hike, even with tighter policy, the Australian dollar only rose about 1%, and gold still bounced. Because the market is starting to understand that the inflation problem isn't going to be solved by a few rate hikes. The structural forces pushing prices higher, fiscal deficits, deglobalization, supply chain reshoring, energy transition costs, these are multi-year themes, not multi-month. And as long as those themes persist, the bid under precious metals will persist too. Now let me talk about silver specifically, because silver's move was even more extreme than gold's, and understanding why tells you something important about this market. Silver hit 121 on Thursday. By Monday, it was at 72. That's a 41% drop, nearly half the value gone in 4 days. Why did silver fall so much harder than gold? 2 reasons. First, silver is a smaller, thinner market. There's less liquidity. Fewer deep-pocketed institutions willing to step in and buy the dip. So when selling pressure hits, the moves are more extreme in both directions. Second, silver had gotten even more speculative than gold. In China particularly, there had been a rush of speculative money into silver that tightened domestic supply and pushed prices into parabolic territory. When that speculation unwound, it unwound violently. But here's the flip side. Silver's fundamentals are arguably stronger than gold's right now. Industrial demand is still rising. Silver is used in electronics, artificial intelligence applications, and clean energy production. Solar panels in particular require significant amounts of silver, and the build-out of solar capacity globally is not slowing down. Meanwhile, supply remains tight. There's been years of underinvestment in silver exploration and mining. The easy deposits have been found. New supply is harder and more expensive to bring online. So you have rising demand and constrained supply colliding with a leveraged speculative flush. The flush cleared out the weak hands. But the supply and demand picture didn't change. That's why silver bounced 12% off the lows. That's why analysts are still talking about silver outperforming gold from here. The short-term violence was about positioning. The medium-term trajectory is about fundamentals. Now let me address something that I think is on a lot of people's minds. Is this the end of the bull market, or was this just a correction? I don't have a crystal ball. Anyone who tells you they know exactly what happens next is either lying or delusional. But I can tell you what the evidence suggests. The evidence suggests this was a classic correction after an extraordinary surge. Prices went up too far, too fast. Leverage built up to unsustainable levels. The system flushed out that leverage. And now we're back to a cleaner starting point. The evidence also suggests that the structural drivers of the rally haven't changed. Central bank buying continues. Individual investor demand continues. Industrial demand for silver continues. Inflation concerns continue. Currency debasement concerns continue. Christopher Forbes from CMC Markets made a point that I think is worth highlighting. He said gold's sharp retreat looks more like a correction than a collapse in the longer-term trend. He said renewed dollar weakness, or confirmation that Warsh will be more dovish than expected, would bring dip buyers back. And he thinks gold can retrace recent highs over the next 12 months. That's not a fringe view. That's a mainstream market strategist saying the bull market isn't over. But here's the nuance that matters. Even if the trend is still up, the path won't be straight. There will be more volatility. There will be more shakeouts. There will be more moments where it feels like the whole thesis is falling apart. Your job, if you're going to be in this market, is to structure your position so you can survive those moments without becoming a forced seller. Because forced selling is how you turn temporary drawdowns into permanent losses. Let me talk about what we should be watching in the weeks ahead, because the next phase of this story is still being written. First, watch the dollar. The Warsh nomination pushed the dollar higher because markets expect tighter Fed policy. But if Warsh's actual statements or testimony suggest a more balanced approach, the dollar could give back those gains. And dollar weakness is fuel for precious metals. Second, watch central bank actions. Not just the Fed, but the ECB, the Bank of England, the Bank of Japan. If other central banks start cutting rates while the Fed holds, that could create cross currents in currency markets that benefit gold. Third, watch physical demand. The paper market just had a massive flush. But the physical market, the actual metal changing hands, that's where the real story lives. If physical premiums stay elevated, if dealer inventory stays tight, if central bank purchases continue, that tells you the paper crash was a financial event, not a fundamental one. Fourth, watch the margin requirements. The CME raised margins over the weekend, and that was a key driver of the crash. If they lower margins as volatility subsides, that could allow leveraged traders to rebuild positions and drive the next leg up. If they keep margins elevated, it could cap the rally or at least slow it down. Fifth, watch open interest. Open interest is the total number of outstanding futures contracts. When open interest collapses during a crash, it means positions are being closed, not just traded. The rebuild of open interest will tell you whether new money is coming back into the market or whether traders are still licking their wounds. Now let me get practical, because I know a lot of you watching are trying to figure out what to do next. If you're sitting on losses from this crash, the first thing you need to do is take a breath. The worst thing you can do right now is make emotional decisions. Revenge trading, doubling down to make it back, or swearing off the market entirely because you're angry. None of those are strategies. Those are reactions. Take some time to assess what went wrong. Was it leverage? Was it position sizing? Was it not having a plan for volatility? Whatever it was, learn from it, because this won't be the last volatile move in precious metals. And the lessons you learn now will determine whether you survive the next one. If you're holding physical metal, you're in a different situation. Physical doesn't have margin calls. Physical doesn't get liquidated at 2 in the morning because the futures market moved against you. Physical just sits there, immune to the paper market shenanigans, waiting for the price to reflect reality. That's the value of physical. Not that it always goes up. It doesn't. But that you can't be forced out. And in a market where forced selling is the primary mechanism for crashes, not being forcible is a significant advantage. If you're looking to enter or add to positions, the question isn't whether this is the absolute bottom. Nobody knows that. The question is whether you're getting a better price than you would have a week ago, and whether your position size allows you to hold through further volatility. Because here's the reality. Gold could fall further from here. Silver could test the lows again. Nothing moves in a straight line. But if your thesis is based on long-term structural factors, if you believe in the inflation story, the currency debasement story, the central bank buying story, then pullbacks are opportunities, not disasters. The key is sizing. If your position is so large that another 20% drop would wipe you out or force you to sell, you're too big. Cut it down to a size you can hold through anything, then let time do its work. Now let me zoom out and put this in historical context, because perspective matters when you're in the middle of a storm. In 2008, after Lehman Brothers collapsed, gold initially plunged more than 25% from its peak near $1,000 to a low around $700. It felt like the end of the world. It felt like gold had failed as a safe haven. And then what happened? Central banks launched quantitative easing, governments ran massive deficits. Currency debasement went into overdrive, and gold went from $700 to $1,900 over the next 3 years. The crash was real. The recovery was even more real. And the people who panicked at the bottom missed the entire next phase of the bull market. I'm not saying history will repeat exactly, but I am saying that crashes in the middle of bull markets are common. They feel terrible in the moment, and they often set up the next leg higher. The question is whether you'll still be in the trade when that next leg happens, or whether you'll be on the sidelines, watching, wishing you'd had the conviction to hold. Let me close with something that I think is important to understand about how these markets work. The system is designed to create moments like this, not in a conspiracy sense, not in a smoke-filled room sense, but in a structural sense. Margin requirements that amplify volatility, thin liquidity that magnifies moves, crowded positioning that creates fragility. These are features of the system, not bugs, and the people who understand these features use them. They don't get angry about them. They don't pretend they don't exist. They position accordingly. Your edge in this market isn't information. Everyone has access to the same headlines, the same data, the same charts. Your edge is behavior. It's the ability to stay calm when everyone else is panicking. It's the ability to buy when fear is highest. It's the ability to hold when the urge to sell is overwhelming. That's not easy. It's not supposed to be easy. If it were easy, everyone would do it, and there would be no edge. But it is learnable. And every crash like this one is a teacher, if you're willing to learn. So here's my ask. If this breakdown helped you understand what happened this week, let me know in the comments. Tell me where you were when the crash hit. Tell me what you did. Tell me what you learned. Because the comment section is where we sharpen the thinking and learn from each other's experiences. And if you think I got something wrong, tell me that too. Challenge the argument. Bring your best reasoning. Because I'd rather be corrected than comfortable. Now the disclaimer. Everything you just heard is for education and general information only. I'm sharing how I think about these markets. I'm not telling you what to buy, what to sell, or what to do with your money. Your situation is different from mine. Your risk tolerance is different. Your time horizon is different. So do your own research, make your own decisions. And if you need personalized advice, talk to a qualified professional who knows your situation. What I can tell you is that the precious metals story is not over. If anything, this week proved how powerful the forces at play really are. And the people who understand those forces, who position correctly, and who have the patience to ride through the volatility, those are the people who will be standing when the dust settles. This is Mr. AG. Stay sharp, and I'll see you in the next one.